fundsupermart.com.
Hi team, what is the outlook for both commercial and residential property in the Asia-Pac region?
The outlook for commercial property in Asia is pretty good at the moment. I think that we're still expecting above inflation retail sales growth. So I think top line rental growth is still going to be pretty positive. I think the story is even better probably for office. Supply is pretty low, and we're seeing a pickup in demand for prime office space at the moment. So for commercial, it's still pretty strong. For residential, it's a little more mixed. We've had a lot of property measures throughout Asia over the last 12 to 24 months, and we anticipate that that's probably going to continue. So I think that the growth in the residential market is going to be more muted, but our base case at the moment is that we're not expecting any further measures in the residential market.
How do you manage the impact of the property tightening measures from the various countries, and how does it impact the fund's returns?
Property measures in the residential sector are probably the biggest risk that we have to face within Asian property, or certainly one of the biggest risks. As mentioned, I think that the impact has already been felt. Certainly when we look at sales volumes, initially they tapered off whenever we had new measures, whether that be in Singapore, Hong Kong and in China as well. And I think that now that we've reached a period where they're stabilising, house prices haven't really risen, and I think that that's ultimately what all of the governments want to achieve. So I think that by and large, they've met whatever their requirements are. So we don't think that house prices are going to necessarily appreciate from here, but I think that the downside is also pretty limited. In trying to measure the impact of that within the fund, then we can't predict whenever property measures will come, but typically it's a buying opportunity for us because volumes tend to rebound in terms of the sales numbers for the residential developers.
What kind of yields do you expect to see in the next 1 to 2 years for this sector?
Looking at where yields are at the moment, they're still at pretty elevated levels relative to where bond yields currently trade. So I think that the gap is probably pretty wide. The markets currently feel to us as if they did something similar to what they did back in 2006, 2007. So I think we're going to get some sort of cap rate compression. To take Singapore, I suppose, office market as a general example, yields are around 5%. It's very possible that we see 1% cap rate compression, which means that the value of the buildings will rise by 25%. So I think we're into a period where we're going to see cap rates continue to fall, and that means that asset values will correspondingly start to rise.
What is the reason for having 41% of the fund's allocation into Japan?
The weighting towards Japan, I suppose, is a function of the companies that we can invest in. So some of the largest real estate companies in the world are domiciled within Japan. So it's a function, I suppose, of their market cap and of their size. I think more interestingly, our view on Japan is pretty positive at the moment. We have been overweight for some time, certainly for the last 6 to 12 months. And that, I suppose, is a view that we've had in terms of Abenomics and the impact that is going to have in terms of inflation. And clearly, real estate is one of the beneficiaries of inflation starting to come through. Recently, we've unwound part of that overweight, but we still think that the Japanese real estate story is one of the most interesting and compelling stories of any market anywhere in the world at the moment.
What are some of the risks investors should be aware of?
The risks are clearly, if you're investing in an Asian property equities fund, you have two main risks, both in terms of the equity market but also in terms of the real estate markets. The risks for real estate are usually policy risk, which we've discussed and we think is probably quite low. The other risk, which is the killer for property, is supply. And if we get a lot of supply, then that's going to be a big problem. But if you think back to where we were 3 to 5 years ago, then it was difficult for people to get finance to build buildings. So as a result, supply coming onto the market today is actually pretty muted. So that's not something that we're particularly concerned about. The equity market component, who knows? I mean, we will be pulled around in short term by any macro factors. And I guess what's encouraging, I suppose, about the start that we've had to this year is that the market has shrugged off any of these concerns. So whether they be what happened in Cyprus, but also in terms of the Italian elections, those were speed bumps along the way in the global equity markets, and we've managed to get through those. So I think that tail risks still remain Europe, and I think that to a lesser extent probably the US and China, but by and large we don't expect those to have a huge impact, certainly in terms of our base case for the next 6 to 12 months.
Thank you, Tim.
Thank you.